It's like being at a fantastic food festival, right? So many choices, but maybe you just want something reliable, something that won't, cause problems if you look away for a bit.
Huh? Yeah, I know that feeling. You're probably after growth, like our friend the learner here, but maybe without having to be glued to your phone checking stocks all day.
Exactly.
Yeah.
That desire for, well, solid growth you can sort of set and forget.
It's a really common one. And it brings us perfectly to our topic today, large cap mutual funds in India.
Okay, let's dive right in then. On this deep dive, we're going to try and unravel this whole world of Indian large cap mutual funds. Our mission, really, is to make sense of it all for you, the learner.
Yeah, we'll look under the hood a bit, see what makes them tick, and maybe even glance at some of the big names that keep popping up.
Right. And large cap in India, we're talking about the really big players, aren't we?
That's it. The top 100 companies listed on the stock exchanges, ranked by their market capitalization, basically, how much the market thinks they're worth. Think uh, established brands, household names.
The giants, not exactly startups. These are pillars of the Indian economy.
Precisely. And to get everyone up to speed, we've, sifted through performance data,
Yeah.
expert views, practical guides, the works.
Okay, so first things first. What are these large cap mutual funds, fundamentally?
Well, simply put, think of them like a big financial potluck. Lots of investors pool their money together.
Okay.
And that pool of cash is then mainly used to buy shares, equity shares in those top 100 companies we mentioned.
Mainly. So not all of it.
Right. SEBI, that's the Securities and Exchange Board of India, they actually have rules. They say these funds have to invest at least 80% of their assets in these large cap stocks.
80%. Okay, so that's the vast majority going into the big stable companies. What about the other 20%?
That's sort of the fund manager's wiggle room. That remaining bit, up to 20%, lets them invest elsewhere. Maybe some promising mid-sized companies or smaller ones, or even other assets, depending on their strategy.
Got it. A little flexibility. So we have this big pool of money, mostly backing the blue chips. How does it actually work for you, the learner, if you invest?
Right. So you're not making the decisions yourself. These funds are run by professional fund managers,
Yeah.
people whose whole job is, well, understanding the Indian stock market.
Experts.
Exactly. They pick which of those top 100 companies to invest in and maybe sprinkle in some others with that 20%. The main goal is usually long-term capital appreciation.
Growing your money over time.
Basically, yes, by investing in established businesses across different industries.
Okay, so you're hiring a pro team. How do you track how things are going? Is there like a score?
Kinda. That's the net asset value, or NAV. Think of it as the price per unit of the fund. It reflects the total value of everything the fund owns, minus expenses, divided by all the units people hold.
So if the stocks the fund holds go up.
Your NAV goes up.
Yeah.
And so does the value of your investment. If you own, say, 100 units and the NAV is 200 rupees, your investment's worth 20,000 rupees. If the NAV climbs, your 20,000 grows.
Fantastic. Hopefully that NAV does more climbing than dipping over the long run. Now, let's talk perks. Why choose these large cap funds? What are the big advantages?
Well, probably the biggest one is relatively stable growth.
Yeah.
Especially over the medium to long term.
Stable growth.
Yeah, these large companies, they've usually been around the block. They have a history of weathering market ups and downs. So the returns tend to be a bit smoother, less volatile.
And that sounds comforting. Less like a crazy roller coaster.
Exactly. Which makes them pretty appealing if you're, say, a bit risk averse or maybe just starting out with mutual funds.
Stability. Okay. Are they really that much lower risk compared to like mid cap or small cap funds?
Generally speaking, yes. They are considered less volatile. These big firms usually have stronger finances. They're better set up to handle economic downturns. The risk of them going bankrupt is, well, much lower.
Makes sense.
And history kind of backs this up. If you look at benchmarks like the S&P BSE 100 Total Returns Index that tracks the top 100 stocks, it's shown positive returns more often over time compared to indices for mid and small caps.
Okay. Lower risk, smoother growth. What else is in the plus column?
Liquidity is another big one. High liquidity.
Meaning easy to get your money out if you need it.
Yes. Usually you can sell your units pretty easily. The underlying large cap stocks themselves are traded a lot, so it's easier for the fund manager to sell assets to pay investors who want to redeem.
Good to know. Easy access is important. What about spreading the risk, diversification?
You get that too.
Yeah.
Even within the top 100, you're getting exposure to lots of different established sectors: banking, IT, consumer goods, you name it. Plus, that extra 20% flexibility can add another layer.
So you're not putting all your eggs in one industrial basket.
Pretty much. And another couple of things. Transparency. These big companies usually have loads of publicly available financial data. It's easier to see what's going on. And potential for dividends. Many large caps pay out regular dividends, which can give you a little extra income stream.
Dividends, always nice. Okay, this sounds pretty good, but there must be downsides, right? Risks.
Absolutely. No investment is risk-free. The key thing with large caps is that the returns might be more moderate.
Moderate.
Yeah, compared to the higher potential growth you might get from smaller companies. Large companies are often more mature, so they might not grow explosively like a small startup could. Think steady oak tree versus fast-growing sapling.
Okay, so maybe not hitting the jackpot overnight, but steadier. Seems like a trade-off. What else?
Well, you still have market risk. Even though they're less volatile, they're not immune to overall market downturns. If the whole market tanks, your large cap fund will likely dip too.
Right, they're still stocks.
Exactly. And there's a very small theoretical liquidity risk in extreme market crashes, but it's less likely for large caps. Also, interest rate risk rising rates can sometimes put downward pressure on stock prices. And finally, there's what's called unsystematic risk.
Yeah.
That's the risk tied to the specific choices the fund manager makes, which stocks they pick, basically.
Got it. So even with the big guys, the manager's skill still matters. Let's just quickly recap why people choose these. Who are they typically for?
Yeah, good idea. Often is investors with a maybe lower appetite for risk, people who prefer steadier gains. They're also a really common starting point for new investors dipping their toes into equities,
Makes sense as an entry point.
and definitely for people with long-term goals. Large caps have a good reputation for performing well over long stretches. Plus, anyone seeking reliable growth from established names or just wanting more stability when the economy feels uncertain.
Okay, that paints a really clear picture. It's about matching the investment to your goals and your comfort level with risk. Right, now for the juicy part, perhaps for you, the learner, let's talk about some specific funds. The names that kept coming up in our sources as top performers in the large cap space in India, and the usual disclaimer applies here, folks. Past performance is not a guarantee of future results, but
But it's certainly worth looking at. And yeah, our research did consistently slag a few funds based on performance metrics. Just remember, different studies might use slightly different time periods or methods, so rankings can shuffle around a bit.
understood. So who's on the list? Let's start with Nippon India Large Cap Fund. What did the data show?
Okay, Nippon India.
Yeah.
It showed up frequently near the top.
Mhm.
One study we saw gave it the highest average return among the funds looked at, around 18.04%, which is pretty strong.
Oh, yeah.
It also scored well on the Sharpe ratio in some analyses. That's a measure of risk-adjusted return, kind of like getting good bang for your risk buck. And a high trainer ratio, too, suggesting good performance relative to market risk.
So good returns and managed risk well, according to those numbers.
Seemed that way in those studies, yeah. It was also listed as a top performer based on its 3-year compound annual growth rate, or CGR, around 19.15% as of April 2025. Another source mentioned a 5-year return of 28.6%.
Okay. And anything else? Size, cost?
Yeah, it's a big fund. Assets under management, or AUM, around 37,500 crore rupees. And the expense ratio in one source was 0.74%.
Okay. Impressive numbers for Nippon India. What about ICICI Prudential Blue Chip Fund? Another very common name.
Yes, ICICI Pru Blue Chip, also a strong performer in the sources. One study had its average return at 15.64% with a good Sharpe ratio of 1.11. It also showed a positive Jensen ratio in one analysis, which suggests it outperformed expectations.
Similar story then, good performance.
Pretty much. Listed with a 3-year CIGR of 17.16% as of April 2025, and a 5-year return around 26.14% was mentioned. This one's even bigger in terms of AUM, almost 65,000 crore rupees.
Whoa, that's huge.
Yeah, massive. Expense ratio is noted as 0.89% in one source.
Okay, another heavyweight contender. Let's move to HDFC Large Cap Fund. What did we find there?
HDFC Large Cap Fund also featured prominently for high returns. 3-year CTRGR listed at 16.39% as of April 2025. Solid 5-year return mentioned too, around 25.34%.
In size, cost?
Also quite large, AUM around 36,000 crore rupees. Expense ratio a bit higher in the source we saw at 0.99%.
Okay, consistently strong returns seem to be the theme for HDFC too. Now, Mirae Asset Large Cap Fund. How did that one look?
Murray asset was interesting. In one study, it actually had the highest average return of the selected funds, over 20%.
Higher than Nippon in that study.
In that particular study, yes. But its Sharpe ratio in the same study was more moderate, 0.95.
Mm-hmm.
And another analysis showed a negative Jensen ratio.
So highest raw returns in one case, but maybe the risk-adjusted picture was slightly different according to those metrics.
Potentially, yeah. It suggests maybe you took on a bit more risk for those higher returns compared to, say, Nippon in that specific analysis.
An interesting trade-off to consider. Okay, lastly, Canara Robeco Blue Chip Equity Fund.
Right, Canara Robeco showed a more moderate average return in one study, around 15.5%. Interestingly, it had the lowest Sharpe ratio and Trainer ratio in one analysis.
Lower risk-adjusted returns in that case.
That's what those metrics suggested in that study. Also a negative Jensen ratio. However, it did have a respectable 3-year KGR listed at 15.24% as of April 2025, and notably, a lower expense ratio was mentioned 0.5%.
Ah, lower costs. So maybe a different profile, potentially lower costs. But the risk-return metrics look different in some studies.
Exactly. It highlights how you need to look at multiple factors.
Definitely. So looking across these, what are the main takeaways? What are the key differences that you, the learner, should notice?
Well, clearly, average returns varied, as did the risk-adjusted returns measured by things like the Sharpe ratio. Some funds seemed more efficient in generating returns for the risk taken, at least historically.
Right.
Expense ratios also differ, sometimes significantly, and lower expenses really add up over the long term, boosting your net return.
That's a crucial point. Small differences matter over years.
Absolutely. Fund size, the AUM, varies a lot too. Big AUM can mean lots of investor trust, but it's no guarantee future performance. And again, different studies, different timeframes, different results, so don't rely on just one ranking.
Okay, so it's not just about chasing the highest number on one chart. You need a broader view. So for you, the learner, trying to choose, what are the really important things to keep front of mind?
Okay, key things. First, look at performance history, yes, but look across different market cycles, how did it do in good times and bad, and look at longer-term trends, like those 3-year, 5-year PAGI Rs. But always, always remember, the past doesn't predict the future.
Got it. History is a guide, not a crystal ball. What else?
Know yourself. Understand your own tolerance for risk. Even large caps wobble sometimes. Be comfortable with the potential ups and downs. Metrics like standard deviation can hint at a fund's volatility if you want to dig deeper.
Knowing your risk tolerance. Check. Next.
Make sure the fund's objective aligns with your goals.
Mm-hmm.
Are you saving for retirement in 20 years or something shorter term? Check the expense ratio. Lower is generally better, all else being equal.
Right. Keep costs down.
Maybe do a little research on the fund manager, their experience, their track record,
Uh,
and definitely compare the fund's performance to its benchmark index, like the Nifty 100 TRI or BSE 100 TRI.
Yeah.
You want to see if it's consistently keeping pace or ideally beating the market it's measured against.
benchmark comparison. That makes sense. Are there other sort of more technical numbers people might look at, or do they want to go deeper?
Yeah, for the really keen, you could look at things like alpha, did it beat the benchmark after accounting for risk?
Yeah.
Beta, how much does it move with the market? We mentioned Sharpe ratio. Sortino ratio is another risk measure. But honestly, the things we just covered are the main essentials for most people.
Okay.
Oh, and maybe glance at the top holdings, just to get a feel for the main companies you'd be invested in.
Right. Good overview of evaluation criteria. Now let's shift to practicalities. Any key personal finance tips specifically for managing large cap fund investments?
Yes. Number 1, think long term. These funds are generally designed for patient investors. Writing out the short-term noise is usually the best strategy.
Patience is a virtue in investing.
Definitely. Also, diversification. While a large cap fund diversifies you across top companies, don't forget overall portfolio diversification. Maybe mix it with debt funds, gold, or other assets, depending on your plan.
Don't put all your savings just in large cap funds. Spread it out.
Okay.
How about actually investing?
Consider systematic investment plans, SIPs. Investing a fixed amount regularly, like monthly. It averages out your costs, takes the emotion out of timing the market.
Rupee cost averaging?
Exactly. And SIPs can start with really small amounts, sometimes just 150 or 500 rupees. Makes it accessible.
Great for regular savers. What about big chunks of money?
Lump sum investing is also an option if you have a larger amount ready to go. Just be aware of market levels, perhaps. And crucially, understand the tax implications. Capital gains taxes apply to your profits. Know the rules for short-term versus long-term gains.
SIPs for discipline, lump sum if you have it, and always be aware of taxes.
Got it. Now, a question that comes up a lot. Large cap funds versus index funds.
Huh?
How do they stack up?
Ah, yes. Good question. Both are generally seen as relatively safer equity options compared to mid or small caps because they focus on those big established companies.
Okay, similar safety profile in that sense.
Broadly, yes. The main difference is active versus passive. Active large cap funds have a manager trying to beat the index, like the Nifty Y100. For that expertise, you pay a higher expense ratio.
Right?
Index funds just aim to match the index performance. They buy the stocks in the index in the same proportion because there's no active stock picking. Their costs, the expense ratio, are typically much lower.
So it's a choice.
Hmm.
Pay more for potential outperformance with an active fund, or pay less to simply track the market with an index fund. That's the core trade-off, exactly. Neither is definitively better. It depends on your belief in active management versus your focus on minimizing costs.
That's a really clear way to put it. Okay, as we start to wrap up this deep dive, what's a final thought you want to leave with you, the learner?
Well, just thinking about the future. As India's economy keeps growing and evolving and, different types of stocks have their moments, it's interesting to consider how these large cap giants will continue to adapt and hopefully keep delivering value for long-term investors like you. Something to ponder.
Food for thought indeed. How the established players navigate the future, and of course we have to say it again, loud and clear. This deep dive is for informational purposes only. It is absolutely not financial advice.
Definitely not. Please consult with a qualified financial advisor before making any investment decisions. They can help you tailor a plan to your specific situation.
And remember, mutual fund investments are subject to market risks. Read all the scheme-related documents carefully. Please do your homework.
Couldn't agree more. Informed decisions are the best decisions.
So, to sum up today, we've journeyed through the world of large-cap mutual funds in India. We've looked at what they are, how they work, the pros, the cons, why people choose them.
And we touched on some of the prominent fund names, comparing them on returns, risk metrics, costs, and size, highlighting key factors for you, the learner, to consider.
We really hope this deep dive has made things a bit clearer, maybe even a little less daunting, and, dare I say, cheerful.
Hopefully you feel more equipped now, the learner,